Thanks so much, Radhika, for taking time out. And given that this time around the expectation is that the governor is going to hold policy rates, maintain the stance, do you think that liquidity management is going to be on top of mind in terms of commentary?
Hi, good morning. Certainly, I think what the markets are looking for are two things. One, does the overall narrative soften, because of the GDP number that have come out and the anticipation that inflation 6 months from now is going to be lower than where we are at this point. And the other one is, what does the central bank make of liquidity at present? Of course, it was in surplus, it then was in deficit, and now it's come back to surplus. But when you look forward again, 1 month hence, because of what's happening on the balance of payment side in terms of portfolio outflows, as well as some of the seasonal outflows, especially insofar as advanced tax flows and all that are concerned. The liquidities are expected to head back to deficit again. But in the grander scheme of things, you really need the base money and liquidity to remain in surplus to allow for, first of all, the transmission to happen, and also secondly, to be growth supportive. I think these are the two things that the markets will be looking for. Of course, liquidity, support, how do they offer it? There are various tools at their disposal. Of late, you have seen the RBI mention time and again that they don't want to do something that's permanent. They would rather do something that is a bit more ad hoc in terms of their variable, repo auctions or reverse repo auctions as and when required. So we will look for that subtle shift that they see reason enough to build in a CRR rate cut, for instance, and take it back to where it was before the pandemic to 4%, which basically means that anything between 25 to 50 basis points remains on the table insofar as the CRR cut is concerned.
Other than that, Radhika, what tools do you think that the MPC has at its hands to try and curb liquidity, which is, of course, thereby going to impact inflation?
Yet I do think they could do a mix. Like I said, they could still stick and with the ad hoc measures and say that the monetary, just the money market operations are enough. They don't really need to do something very specific. Apart from that, one of the things that has actually also caused a drain on liquidity is what's happening on the currency front. Intervention has been stepped up. And because of that, you've actually seen a lot more of a squeeze, and they've left it unsterilized, right? So there could be just some sterilization tool that could be considered, especially insofar as buy-sell swaps are concerned. So the options, so there are the money market operations, then there are the sterilization tools, and then there are, of course, permanent injections like CRR. I think there is room there because, again, it won't hurt banks as much. And you've got stricter LCR norms that are also going to come up. So from that angle as well, banks will get some relief. So these are the various options available. So we will wait to see, and what they do will give an indication of how. What's the nature of the liquidity deficit that they see? Is it where they need to do permanent, or they need to do only, temporary? Because of frictional drivers, they've actually seen a squeeze. But because of, usually you see advanced tax flows, GST tax movements, that is okay. Government spending provides some relief. But at this point, it's more also the outflows that you've seen, portfolio outflows, that have aggravated the shortfall. Hence I think the shift in the market's mood that they could do something more permanent insofar as a CRR change is concerned.
All right. And what's the expectation when it comes to the overall GDP, given that we were working with a 7-quarter low on the GDP print for Q2? What is the expectation in terms of tweaking or the growth projections for GDP?
So the last Friday's numbers, of course, came in well below expectations. I think we had expected slower numbers, but obviously the headline number was much lower. I think there could be revisions down the line. I mean, usually in February, you see a bit of a backward, revisions in the data. You could see this 5.4% actually be a bit higher. Nonetheless, I think the point being that there are some idiosyncratic shocks that had depressed growth in the first half of the year. You had elections, and then the delay in spending, construction activity also slowed down. You had mining activity because of unseasonal rains and impact on farm output as well. And then, of course, you have the manufacturing sector underperformance. Manufacturing sector underperformance has been in the works for a few quarters now, but seem to have hit a low in the second quarter of the fiscal year. Second half of the year, we, in fact, expect some of these idiosyncratic shocks to actually even out. Government spending, there is a big jump required in the second half, almost 52%. I think that will be a bit difficult, which means that budgeted target might not be met, but on a month-on-month basis, you will actually see increase. And we do think that farm, if had two back-to-back seasons of good rains, some of that, when it translates into higher incomes, that will benefit rural consumption as well. And if, as we anticipate, the central bank eases some of the macroprudential measures, eases some of the, some of the rate cuts, liquidity measures, that will also, make monetary conditions less tight. So these things, amalgamation of all of this, we think, could provide relief in the second half of the year. But on full year basis, our growth number is right now about 6.3%. So certainly, I think adjusting to what has, been a much softer first half than previously anticipated.
Okay, fair enough. And anything in particular, Radhika, that you think will be a big concern going down the line? Do you think that it will be inflation, growth metrics, tinkering with rates? What do you believe is going to be the concerning factor when it comes to India macros?
I think concern, not so much per se. I think from the central bank's point of view, certainly they are juggling many balls. You've got, growth, inflation on one hand, and what's happening globally, which is quite beyond what the regional policymakers can do. I think that will be the biggest risk for most central banks. What kind of policy, especially from the U.S. front, are the protectionist policies, are the anti-trade policies, and that will surely impact different countries through different measures. But I don't think anybody will, escape unscathed. And fortunately, India's exposure to US, so India's trade and investment linkages to the US is much stronger than China. So that way, and I think it has a natural advantage. But nonetheless, I think if, say, there is across the board import tariffs, and if you remember back in 2016, 2018, 2019 also, there were some exchange of tariffs between India and the US as well. So, if we have a redo of that, there certainly is likely to be some skirmishes. So I would think, coming back to your question, while what is within India's power, one can control, which is inflation and growth, but what happens globally is going to be an equally big challenge as well. And I think that pass through could be through rates, FX, as well as global dollar liquidity.
Right.
If you like this video, then like, share and subscribe to ET Now.